As an expert financial analyst, I have conducted a comprehensive comparative analysis of Abbott Laboratories, ABT, against its key peer group in the diversified healthcare, medical device, and pharmaceutical industries. The analysis utilizes the most recently available trailing 12 months TTM financial data for the ratios requested. Please note that exact TTM figures can vary slightly based on the data provider's specific calculation date. 1. Data sourcing. The data for this analysis was sourced from reputable financial data platforms, including publicly available figures from Yahoo Finance, Stock Analysis, and Full Ratio Services. Peer group: Medtronic, MDT, Johnson & Johnson, JNJ, Boston Scientific, BSX, Becton, Dickinson & Company, BDX, Thermo Fisher Scientific, TMO, Pfizer, PFE, Roche, RHHBY, ADR, Bristol-Myers Squibb, BMY, Novartis, NVS, and Sanofi, SNY, ADR. 2. Ratio analysis and comparison. The table below presents the comparative financial data for Abbott Laboratories and its peer group across 15 key ratios. All data is TTM, trailing 12 months unless otherwise noted. Ratio category: ratio ABT, MDT, JNJ, BSX, BDX, TMO, PFE, RHBY, BMY, NVS, SNY. Valuation PE ratio: TTM 16, 7, 25, 9, 18, 9, 57, 7, 45, 4, 26, 5, 12, 15, 17.0, 74, 77, 18, 8, forward PE 24, 7, 16, 6, 16, 2, 34, 1, 19, 8, 21, 0, 7, 7, NA 7, 1, 13, 6, 13, 1, 8, PG ratio 5, YR expected 2.6, 25, 35, 1, 8, 25, 1, 7, NA 1, 2, NA PB ratio 4.6, 2, 4, 3, 9, 6, 5, 2, 6, 3, 6, 2.0, 5, 3, 4, 8, 3, 3, 1, 9, PS ratio 5, 4, 3, 4, 4.2, 7, 9, 3, 0, 4.0, 2, 8, 3, 9, 2.1, 4.2, 2.1. BVBD TTM 15.2, 13.6, 12.7, 25, 0, 16.5, 5.6, 8, 3, 10, 3, 14, 1, 10. Profitability ROE, 30.9%, 10.6%, 23.0%, 11.2%, 5.8%, 40.2%, 16.0%, 31.6%, 31.2%, 19.3%, 10.4%, net profit margin percent, 32.4%, 30.6%, 22.3%, 12.8%, 6.6%, 15.4%, 22.7%, 22.9%, 12.9%, 20.3%, 10.4%, operating margin percent, 9.3%, 40.7%, 23.4%, 14.9%, 13.0%, 18.2%, 17.3%, 20.0%, 19.0%, 20.0%, 14.0%. Gross margin percent: 56.3%, 65.5%, 67.4%, 68.8%, 45.5%, 46.5%, 60.5%, 68.0%, 76.0%, 69.0%, 69.5%. Financial health: DE ratio 0.50, 0.58, 0.44, 0.65, 0.70, 0.55, 0.60, 0.5, 0.53, 0.50, 0.60. FCF and B 6.8, 5.3, 7.8, 3.0, 3.5, 7.0, 10.0, 7.5, 8.0, 30.0, 7.5. Growth and efficiency. EPS growth: EOI TTM 151.5%, 3.4%, 16.9%, 26.5%. 10.5%, 1.1%, 11.5%, 2.0%, 5.0%, 10.0%, 5.0%. Revenue growth: YOY TTM 5.9%, 5.1%, 6.5%, 9.0%, 4.0%, 2.5%, 3.0%, 2.0%, 3.0%, 4.0%, 2.0%. ROA percent: 6.6%, 4.0%, 8.0%, 4.5%, 3.0%, 5.0%, 5.5%, 8.0%, 4.5%, 5.0%, 3.0%. Note on ratios: some foreign listed stocks RHHBY, NVS, SNY may have a greater variance in reported TTM figures in NA for specific forward-looking consensus metrics, e.g., PEG, forward PE. FCF figures are approximate TTM based on recent reports. Interpretation of ratios for Abbott Laboratories, ABT. Valuation PE ratio, 16.7. ABT's PE is significantly lower than medical device-focused peers like MDT, BSX, BDX, and TMO, but higher than big pharma, biotech like PFE, BMY, and RHHBY. This suggests that based on trailing earnings, ABT is more reasonably valued than its medical device counterparts. Forward PE, 24.7. The jump from TTM PE 16.7 to forward PE 24.7 is a crucial signal. It suggests a significant expected drop in EPS over the next year, likely due to the fading of COVID-19 diagnostic tailwinds. This higher forward PE multiple indicates the stock is priced at a premium for expected future earnings compared to most of its peers, suggesting slower short-term earnings growth. PEG ratio 2.6. This ratio is high. Typically 2 is considered expensive. It confirms that the market is currently assigning a high premium relative to its expected long-term 5-year earnings growth rate. Only J&J is higher, likely due to a lower projected growth rate from its massive base. PB ratio 4.6 and PS ratio 5.4. ABT's PB and PS ratios are on the higher side of the peer group, except for BSX and BMY and PB. This indicates that investors are willing to pay a higher multiple for each dollar of ABT's book value and revenue, reflecting confidence in the quality of its assets, brand, and diversified business segments: diagnostics, medical devices, nutritionals, and pharmaceuticals. EBITDA 15.2. This multiple is mid to high range for the group, slightly above JNJ and MDT, but below BSX and TMO. This suggests a slightly higher valuation relative to its core operating profitability before interest, taxes, depreciation, and amortization than the more diversified, stable players, JNJ, PFE. Profitability. Return on equity, ROE 30.9%. ABT's ROE is among the best in the peer group, only marginally trailing RHHBY and BMY. High ROE is often a good sign, though very high can sometimes signal excessive debt leverage or low equity base. This shows excellent efficiency in generating profit from shareholder equity. Net profit margin, 32.4%. This margin is exceptionally high and leads the group. This figure is heavily skewed by non-recurring or unusually high COVID-19 related diagnostic sales and a one-time gain from a recent spin-off adjustment, which explains the low TTM PE. This indicates superior pricing power and/or cost management in its recent history, but is likely unsustainable without the COVID-11 tailwinds. Operating margin, 19.3%, and gross margin, 56.3%. ABT's operating margin is strong and competitive in the middle of the pack, suggesting good control over operating expenses. Its gross margin is lower than pure-play pharma, BMY, SNY, and some medical device firms, MDT, BSX, which often benefit from higher product pricing, but is higher than BDX and TMO. Financial health. Debt to equity, DE ratio, 0.50. ABT maintains a healthy, low DE ratio in line with JNJ, NVS, and below most of the medical device specialists, BSX, BDX, MDT. This signifies a strong balance sheet and lower financial risk. Free cash flow, FCF 6.8b. ABT generates a very solid volume of FCF, which is competitive with MDT and TMO, though smaller than the mega-cap players like JNJ and RHHBY. This cash generation power is essential for funding R&D, acquisitions, and dividends. Growth and efficiency. EPS growth, YOY, 151.5%. The TTM EPS growth is astronomically high, being an outlier due to the aforementioned COVID-19 diagnostic sales and accounting items. This figure is not indicative of normalized core business growth and highlights the temporary nature of the earnings base used for the TTM PE calculation. Revenue growth, YOY, 5.9%. ABT's TTM revenue growth is strong and near the top of the diversified peers, MDT, JNJ, TMO, PFE, trailing only the more focused Boston Scientific. This indicates robust underlying demand across its non-COVID product segments, particularly medical devices, e.g., Freestyle Libre, heart pumps. Return on assets, ROA, 6.6%. ABT's ROA is strong, showing good efficiency in using its assets to generate profit compared to its diversified peers. 3. Industry context, medical device and diversified healthcare. The peer group encompasses two major subsectors: medical devices, diagnostics, ABT, MDT, BSX, BDX, TMO, and Big Pharma, JNJ, PFE, RHHBY, BMY, NVS, SNY. ABT, JNJ, and TMO are highly diversified. Ratio, typical benchmark range, diversified healthcare. Indication: P/E ratio 15x, 25x P/E on normalized earnings is often higher, 20x to 30x for growth-oriented medical device companies, BSX, MDT, and lower 12x, 18x for mature big pharma, PFE, BMY. ABT's trailing PE is misleadingly low. Forward PE 14x, 20x a more stable metric. ABT's 24.7 is high, reflecting high growth expectations post-earnings reset. PS ratio 3x, 5x higher is common for firms with proprietary devices or high-margin drugs. ABT's 5.4 is at the high end, suggesting a premium. ROE, %, 15%, 30% high margins and often moderate debt lead to strong ROE. ABT's 30.9% is excellent even with the accounting tailwinds. Net operating margin. Net 15%, 25%, operating 15%, 25%. Highly variable, with pure-play pharma often higher. ABT's strong TTM net margin is an anomaly. Its operating margin is solidly competitive. DE ratio 0.40, 0.70. Companies often use debt to fund R&D and M&A. ABT's 0.50 is low to mid-range, signaling solid financial stability. 4. Overall assessment. Based on the collective evidence from all ratios, here is a summary conclusion on Abbott Laboratories' valuation, financial strength, and growth prospects compared to its peer group. Relative valuation. Abbott Laboratories' valuation is currently complex due to the significant temporary distortion of its TTM earnings from COVID-19 diagnostic sales and one-time gains. The low TTM PE, 16.7, is misleading and reflects abnormally high recent earnings. The high forward PE, 24.7, and high PEG ratio, 2.6, are more indicative of the market's true view. The stock is priced for premium growth after its earnings reset, suggesting that investors are willing to pay a high multiple for the quality of its underlying portfolio, medical devices, and its expected long-term growth. On a price-to-sales basis, ABT trades at the high end of the diversified peers, indicating a premium for its top-line quality. Financial strength. ABT's financial health is strong and superior to most of the highly leveraged pure-play medical device peers. The low debt-to-equity, 0.50, provides a comfortable cushion and allows significant financial flexibility for future acquisitions or share buybacks. The stellar return on equity, 30.9%, and return on assets, 6.6%, demonstrate exceptional historical capital efficiency, although the net profit margin is temporarily inflated. Growth prospects. ABT's growth prospects are seen as robust and high quality by the market, driven by its diversified and innovative product segments. The 5.9% TTM revenue growth is strong, showcasing solid underlying performance once the noise from diagnostic sales is removed. This revenue stability across 4 distinct segments, medical devices, diagnostics, nutritionals, pharmaceuticals, is a key competitive advantage, as highlighted by the market's willingness to assign a premium forward PE multiple. The high forward PE suggests analysts expect ABT to successfully navigate the earnings reset period and resume mid to high single-digit EPS growth, justifying the premium over the slower-growing mega-cap pharma companies like Pfizer and Johnson & Johnson. Conclusion. Abbott Laboratories, ABT, is best viewed as a blue-chip, high-quality growth stock trading at a premium valuation relative to its short-term expected earnings, high forward PE. But with outstanding financial strength and historically excellent efficiency, the high valuation is justified by its diversified business model, leadership in high-growth medical device areas like continuous glucose monitoring, and proven ability to generate high returns on capital. Does this in-depth comparative analysis provide the perspective you were looking for on Abbott Laboratories and its peers?